Welcome to the Deep Dive, where we take the sources you're curious about and extract the key insights, making you well-informed without the overwhelm.
That's right.
Today, we're digging into a PDF called Trader's Money Management System.
And this is really for you, someone who wants to grasp new information thoroughly but, efficiently.
Yeah, those aha moments are what you're after, and we're definitely aiming to keep things digestible, avoid that information overload.
Exactly.
So our mission today is pretty straightforward. Explore the essential principles of money management and trading straight from this PDF.
We want to give you a clear sense of why it's just so crucial and, maybe more importantly, how you can actually use these ideas.
Okay, let's unpack this then. Where do we start?
Well, right off the bat, the author and publisher put in a disclaimer. It's pretty standard stuff for financial advice, really.
Okay, the usual not financial advice, consult a pro.
Precisely. They make it clear they aren't guaranteeing accuracy or suitability for your specific situation. Always best to talk to a professional.
Got it. And they give contact info, Wiley website.
Yep, contact details for support, and they point you to the Wiley site if you want to explore more.
And the author themselves, what's their background?
Well, the author runs a firm that focuses on trader education. You can find it at candlecharts.com/free education.
Ah, candle charts. So they're big on candlestick charts then.
They are, but here's the interesting bit. He actually believes they're often misused.
Misused. How so?
Like, traders treat them as the only tool they need, a standalone solution. He argues against that.
Okay, so use them but not in isolation.
Exactly. Combine them with other analysis. Understand risk and reward.
Yeah.
Don't treat them like some kind of magic bullet.
And adding weight to this, the foreword is by Steve Neeson, the candlestick guy.
The candlestick guy, yeah. Widely seen as the leading expert. And Neeson makes a really interesting connection.
Which is?
He links the timing signals you get from candlesticks with the absolute need for disciplined money management.
Ah, so it's timing plus discipline.
Right. He says when you combine those, knowing when to act, with the discipline to manage your risk, it builds confidence. And surprisingly, he says it even reduces the stress of trading.
Reduces stress. I like the sound of that. Trading can be intense.
Definitely. Neeson even shares a Japanese samurai saying, "He whose ranks are united in purpose will be victorious." Really drives home that idea of bringing timing and money management together.
Powerful image. Okay, so moving into the core ideas. The author calls money management unsexy.
Yeah. His point is, it might not sound exciting at first.
Right.
Compared to finding the perfect entry signal or whatever.
Sure, spreadsheets aren't always thrilling.
But it becomes compelling, he argues, when it actually starts leading to profits and, crucially, stops you from blowing up your account. That's when it gets interesting.
Right, avoiding ruin is pretty compelling. So it connects to psychology then.
Hugely. He really emphasizes developing a strong risk control mindset. Says it's fundamental if you want to create a personal money management plan you can actually stick with.
And that sticking with it is the hard part, isn't it?
Absolutely. But mastering that psychology, he says, leads to less anxiety. Makes you more likely to follow your own rules consistently.
And it feeds itself, right? Good management leads to profits, which reinforces the good psychology.
Exactly. It becomes a positive feedback loop. Success breeds more confidence, makes it easier to stay disciplined next time.
To really hammer this home, I see he shares some personal stories, pretty painful ones.
Oh, yeah. Very impactful. He talks about a trade in applied materials, and it went badly wrong.
What happened?
Well, the key thing was the emotional side. The trade moved against him, but instead of cutting his losses,
He held on, hoping.
made excuses, hoped for a turnaround, ended up losing $30,000 in just 3 weeks.
Wow, 30 grand. That's gotta sting.
And it didn't stop there. He was frustrated, wanted to get even.
Ah, the revenge trade.
Yeah.
Never ends well.
Rarely. He jumped back in, bet the other way on the same stock, lost another $2,000.
Ouch.
He describes the emotional devastation, how it just sucked all the enjoyment out of trading for him. Really brings it home.
And there's another one, penny stock.
Yeah, another tough lesson. Put $22,500 into a penny stock based on analyst recommendations.
Let me guess.
Company went bankrupt. Investment became worthless. Zero.
Man, those are harsh lessons.
Definitely. But he says those experiences completely transformed him, made him a total money management believer.
I can see why. The lesson being?
The immense value of taking small, manageable losses instead of letting things spiral into those catastrophic hits that can wipe you out.
It's protection, really. And he mentions writing this during the California wildfires. What's the connection there?
Yeah, it's an interesting aside. He uses it to underscore how unpredictable life and markets can be. The need to be prepared for the unexpected, like having an emergency plan.
Right, because you never know what's around the corner in trading either, which leads into managing different kinds of risk.
Exactly. He introduces the idea that you need to plan for the unexpected by considering different types of risk.
How many does he list?
He mentions there are 6 primary types of risk that traders should think about for every single trade.
Okay, 6 types. Does he name them here?
Not in this specific section, no. He says they'll be covered in detail later, but he sets the stage you need to be proactively thinking about potential challenges.
Got it. And this loops back to psychology again, doesn't it? The mind's role.
Always circles back. He really hammers home that our own mindset, our psychology, can often be the biggest barrier to financial success in trading.
So it's not just about the charts or the system, it's about what's going on in our heads.
Absolutely. He even calls addressing that underlying psychology the potential magic key to breaking through profit plateaus, getting unstuck, essentially.
A magic key. Interesting
Yeah.
phrasing. And he mentions concepts like yin and yang.
Yeah, he brings in this idea of yin and yang, these opposing forces, like weakness, strength, down, up, bear, bull markets.
Okay, how does that apply to trading psychology?
The idea is that these forces are always influencing us. He uses a table in the book with examples. The point isn't to fear weaknesses or get cocky about strengths.
It's about balance, awareness.
Exactly. It's about recognizing both sides within yourself, your tendencies, and using that self-awareness, that introspection, to improve your trading.
So a perceived weakness might actually be useful sometimes.
Potentially, yeah. He argues that traits aren't inherently good or bad in all situations. Sometimes being, say, cautious or passive could be an asset.
He mentions women sometimes being considered better traders for that reason, being more passive or flowing with the market.
He touches on that view, yeah. The idea of being patient, not trying to force things. The text gives lists of current strengths and weaknesses to get you thinking about your own profile.
Okay, so self-assessment is key, which leads to developing the trader's mindset. What defines that?
Well, first off, he stresses it's not a destination, it's a continuous process, a work in progress for everyone.
Even the pros.
Even the pros. They still deal with fear and greed. The core idea is having a deep understanding of your psychology and how it hits every trade.
Makes sense. What are some characteristics of this mindset?
Things like not needing to conquer or predict the market, feeling confident but in control of your actions, trading with risk capital you can actually afford to lose.
And taking responsibility.
Huge one. Taking full responsibility for all outcomes, wins and losses. No blaming the market or your broker.
He mentions 15 destructive psychological trading issues, too.
Right. And he says, just identifying which of those apply to you is the critical first step.
Like knowing your enemy.
Kind of. And some issues, like trading the wrong size, he notes will be tackled specifically later when discussing money management techniques.
And he suggests revisiting this mindset section after building a plan.
Yeah, it's smart. See how putting concrete rules in place might already be helping address some psychological hurdles.
Okay, shifting gears slightly. Trading as a game of probabilities, like a casino.
Exactly that analogy. Casinos don't know if the next hand wins or loses, right? But they know their overall edge. Over thousands of hands, they expect a profit.
So traders need that long-term statistical view.
Precisely. Don't get hung up on any single trade outcome. Focus on the process and the probabilities over time.
He tells a story here too, doesn't he? About some friends and an inheritance.
Yeah, really cautionary tale. Late 90s, tech boom. Friends turned a $50K inheritance into over $1 million.
Wow. Incredible gain.
Incredible, yeah.
God.
But highly leveraged tech trades. And crucially, they had no exit strategy, got emotionally attached to the huge paper profits.
Oh no. I see where this is going.
Yep. Tech market turned down hard in 2001. They couldn't react, couldn't pull the trigger, lost it all.
Not just the million, but the original $50 too.
Everything. And he emphasizes the lasting emotional damage from that. Just devastating.
What a stark lesson. The takeaway being,
Emotional balance is crucial. During wins and losses, aim for steady, consistent growth, not those wild swings that can vanish overnight.
that ties into perfectionism, doesn't it? Some people struggle with the idea of ever being wrong.
Big time. Especially perfectionists. How do you cope with losing trades if you strive for flawlessness?
He uses pilots as an analogy.
Yeah, it's relatable. Pilots are meticulous, procedure-driven.
Yeah.
Being wrong can be catastrophic in their job. So taking a stop loss in trading can feel like a major failure to them.
But it's not a crash, right?
Exactly. That's the mental shift. A stop out in trading isn't a plane crash. It's a course correction. It's normal to be wrong on trades. Look at the big picture, the long-term flight path of your account.
Okay, so accepting imperfection is key, which brings us to some fundamental rules he lays out for profitability.
Yes, some core principles. Non-negotiables, really.
Like always using a stop loss.
Always. And one based on market dynamics, not just a random number.
And actually sticking to it.
Yeah.
Psychologically.
That's rule 2. Develop the psychology to adhere to your stops. Don't override them emotionally.
Rule 3 is about trade size.
Determine the proper trade size. He mentions the 2% guideline risk, no more than 2% of your capital on one trade. We'll probably circle back to that.
Okay. And the last one.
Maintain impeccable records. Track everything.
Got it. Stop loss, psychology, position size, records. Let's dig into stop losses more, linked to the trading system.
Inextricably linked, he says. Good money management needs a system that helps identify high-probability spots for those stops based on what the market's actually doing.
He talks about initial stops and trailing stops, using RT software as an example.
Right. RT is their software, applied reality trading. An initial stop is what you set right at the start, defines your max risk on that trade, helps you calculate position size.
And trailing stops?
Those come into play once the trade moves in your favor. They adjust, move up behind the price if you're long, for instance.
So they lock in profits.
Exactly. They trail the price, protecting gains while still giving the trade room to breathe. Dynamic.
Makes sense. What about scaling out, taking partial profits?
Another technique he discusses. Taking some money off the table as a trade works.
Why do that?
Can boost overall profitability, he argues, and definitely reduces stress. Less worry about giving back all your open profit.
But you need a decent-sized position to start with, right, for partial profits to be worthwhile.
Good point.
Yeah.
Yeah, the initial trade size needs to be large enough to make scaling out practical.
He shows an example. Bearish trend, using signals to exit in thirds.
Yep, uses RE signals in an example, taking profits, say, 1/3 at a time as the downtrend unfolds. Psychologically, locking in some profit makes it easier to stay in the trend longer.
Less fear of a reversal wiping out all the gains.
Precisely.
And the opposite scaling in, adding to winners.
He mentions that briefly, too. Adding to trades that are already working, usually in strong trends.
Sounds riskier.
It can be.
Yeah.
He stresses that risk control is absolutely critical when you scale in because you're increasing your overall exposure. It needs careful management.
Okay, let's talk risk percentage. How much capital to risk per trade? He introduces optimal F.
Ah, yes, the optimal fraction, F. It's a formula to calculate a theoretically optimal percentage of your capital to risk
Based on
your historical trading stats. Specifically, your average payoff ratio, how much you win versus lose on average, and your average win ratio, what percentage of trades are winners.
Is the formula complicated?
It looks a bit mathy.
Yeah.
F, A plus 1 AP.
1A.
A is payoff ratio, P is win ratio.
Okay. Maybe a bit much for audio. Does he give an example?
He does. Plugs in numbers, say, payoff of 2-to-1, win rate of 35%, and gets an optimal F of 2.5% risk per trade.
So 2.5% in that case. How does this compare to other methods, like risk of ruin tables?
Good question. Optimal F is generally seen as more aggressive. It aims to maximize growth based on your past results. Risk of ruin tables often focus on finding a risk level that gives you, say, a 0% chance of total ruin, which might be a lower percentage than optimal F.
So optimal F might give higher returns, but maybe a higher chance of a big drawdown.
That's the trade-off, potentially. It's about maximizing geometric growth, which can involve more volatility than minimizing ruin probability.
Speaking of drawdowns, he tackles that directly. Account drawdowns.
Yes, very important topic.
Yeah.
He makes it clear that drawdowns, dips in your account, equity from a peak are totally normal. Expected, even.
But they scare novice traders.
Often ruins them, he says. Because they haven't learned proper risk control, they panic, abandon ship, or double down trying to make it back fast.
So what should you track regarding drawdowns?
He lists key historical data points. Your largest percentage drawdown ever, your largest dollar drawdown, and your longest string of consecutive losing trades.
Why track those specific things?
Because knowing your history gives you context. If you know your system historically has had, say, 7 losing trades in a row maximum, then when you hit loss number 5...
You don't freak out quite as much.
Exactly. You understand it's likely within the normal range of performance for your system. It helps maintain confidence and perspective during those inevitable rough patches.
Okay, that makes sense. Let's get practical again. Position sizing and that 2% rule he mentioned.
Right, the basic 2% risk rule.
No.
Pretty simple math.
Account size times 2% equals.
Equals the maximum dollar amount you should risk on any single trade.
And that risk amount includes everything, not just the price move.
Crucial point. Yes, it needs to cover potential commissions and slippage, too, not just the distance to your stop loss. Get the total potential cost.
He gives an IBM example, calculating max shares.
Yep. Walks through calculating how many shares of IBM you could trade based on your account size, the 2% rule, and where your initial stop loss is placed. Even accounts for using margin.
Very practical. Now, record keeping, you mention it as a key rule, but people resist it, right?
Oh, hugely. It's like flossing for traders. Everyone knows they should, but
Yeah. Why do people avoid it?
lots of reasons he covers. Feeling overwhelmed, bad past experiences, thinking I'm not an analytics person, finding it painful to look at losses.
Or even wins, sometimes. Weirdly.
Yeah, psychological discomfort with wins can happen too. Or just thinking time is better spent hunting for the Holy Grail system.
So, what are his solutions?
Break it down. Small steps. Simplify your system if it's too complex. Delegate if possible. Directly address the psychological discomfort. Why does looking at losses bother you so much?
And fundamentally understand the value.
That's the core. Understand how record keeping directly improves your psychology and your bottom line. It's not just busy work, it's a tool for improvement.
Okay, so if you're convinced, what specifically should you track? The vital statistics.
Yes, his trading vital statistics. Like a doctor checking your pulse and blood pressure, these stats check your trading health.
It's on the list.
Let's see. Win ratio, payoff ratio, commission ratio, largest winning trade, largest losing trade, average winning trade, average losing trade.
Okay, win-loss metrics. Anything else?
Yeah, largest number of consecutive losses, average number of consecutive losses, and then your largest and average account percentage drawdown.
That's quite a list. Let's pick one win ratio. Simple percentage of winning trades.
Yep, percentage of winners to total trades. Pretty straightforward.
Higher is better, obviously, but 100% is impossible.
Right, totally unattainable. But he also notes if your win ratio is really low, like way below what your strategy should produce.
It might be you, not the system.
Could be pilot error, as he calls it. Fatigue, emotions, not following rules, human factors messing things up. Worth investigating.
To manage all this data, he introduces the Trader's Assistance system. What is that?
It's basically his structured framework for record keeping, designed to track everything from the big picture, like an annual summary, down to the nitty-gritty of each individual trade.
What kind of forms are involved?
9 different ones, actually. Annual, monthly, weekly, daily ledgers, a daily worksheet, then specific trade posting cards for future stocks, options, and a trading scorecard. It's quite comprehensive.
It sounds like a lot. Where did it come from?
He developed it for his own trading back in '95. Says it's adaptable to any market, any time frame, day trading, swing trading, investing.
And he specifically recommends handwriting the stats in this digital age.
He does. It's intentional. He believes physically writing the numbers creates a stronger connection to your results, engages more of your brain than just typing into a spreadsheet. Makes it more tangible.
Interesting take. What's the annual ledger like? The ultimate scorecard.
It's the year-end summary. He shows an example, a student's paper trading results for 2007. They made like 50.7%.
Nice gain. What metrics does it show?
All the key ones. Overall win ratio, payoff ratio, commissions as a percentage, biggest win-loss, average win-loss, consecutive losses, max drawdown for the whole year. Gives you that high-level overview.
And you can spot issues there. System problems, money management slips.
Absolutely. See which months were great, which were rough, overall return, big picture insights.
Then there are monthly ledgers.
Yep, breaks it down month by month. He shows a profitable January '07 and a losing June '07 as examples. Helps you see shorter-term trends or maybe periods where things went off track.
And weekly ledgers go even finer.
More granular view, yeah. Shows examples, a losing week, a winning week. You can see the impact of maybe specific news events or how a particular week unfolded.
Then the trade posting cards, those are for individual trades.
Exactly. One card per trade captures all the details. Entry, exit, stop, size, profit loss, maybe even notes on why you took the trade or how you managed it.
So you can analyze winners and losers separately.
That's the idea. Go back through your winning cards, your losing cards. What patterns emerge? Where can you improve?
There's also a trading scorecard.
Kind of a quick summary sheet for the key metrics. An at-a-glance view of your trading health.
And plotting the equity curve. Visualizing account growth.
Crucial practice, he says. Plot your account balance over time. See if the growth is steady or erratic. Clearly identifies drawdowns and recovery periods. Makes it visual.
He mentions Tushar Shanday's work on analyzing equity curves.
Briefly, yeah. For those wanting to go deeper into interpreting the patterns in their equity curve.
In practically setting this up, binders and files.
Simple physical setup. Binders, tab dividers for the different ledgers, annual, monthly, etc., and file boxes to keep the trade cards organized, maybe one for open trades, one for closed. Keeps it all accessible.
Okay, that's a very structured system. Underlying all this, though, is discipline, right?
Absolutely fundamental. He says consistent success boils down to discipline in two areas: following your money management rules and following your overall trading plan rules.
And he has a tool for assessing that, a discipline profile.
Yeah, another self-assessment checklist. Helps you gauge your natural tendency towards discipline, following rules, staying organized, focus. You get a score.
How does that score help?
You combine it with your risk profile score from earlier in the book. Understanding your comfort with risk and your natural level of discipline helps you design a trading plan that actually fits you.
So if you're naturally less disciplined, maybe you need stricter rules or simpler ones.
Exactly. Or maybe someone highly disciplined but very risk-averse needs to consciously push themselves a bit. It's about tailoring the plan to your personality, making it sustainable for you.
So based on that self-knowledge, you establish personal money management rules. He gives examples.
Yes, concrete examples, like rules for stop losses. Always use trailing stops once profitable. Never move a stop further away emotionally. Adjust stops correctly if scaling in. Give stops room to breathe.
And rules for scaling out.
Like maybe always take profits in thirds at predefined points or based on certain signals. Specific, actionable rules.
Before risking real money, though, paper trading.
Huge advocate for it. Simulating trades without real money on the line.
Why is it so valuable?
It's a stress-free environment to practice your strategy and your money management rules. Focus on execution without the fear and greed that real money brings. Build good habits.
Even though it's not exactly the same emotionally?
It's not identical, no. But it's invaluable for refining your process and building confidence in your rules before you risk actual capital.
He has a 10-step plan for paper trading.
Yeah, a structured approach. Define rules, paper trade, evaluate using the trader's assistance system, use blocks of 25 trades for analysis, practice till consistently profitable on paper.
Then transition slowly.
Right. Achieve several profitable blocks on paper. Then start live with very small capital, still tracking everything, gradually increase size as you prove consistency, and always keep evaluating and adjusting.
He makes a distinction between paper trading and backtesting.
Good point. Backtesting is analyzing historical data. Paper trading is simulating future trades in real time, or close to it. He sees paper trading as vital for testing not just the system, but your own ability to follow it under simulated conditions.
Useful clarification. Okay, wrapping up, he lists resources for further learning.
Yes, a good list of relevant magazines and periodicals, Stocks and Commodities, Futures Magazine, Active Trader, etc. Give websites, costs, frequency.
And his own site, Expos.
Mentions his site, traderscoach.com, again. Points out upcoming traders, XPOs, and money shows as good educational and networking opportunities.
And an online course.
Yeah, highlights a free online money management course he offers through the Money Show University. So lots of next steps if you want them.
And finally, a glossary.
Yep, comprehensive glossary at the end for any unfamiliar trading terms. Handy reference.
Okay, so pulling it all together after this deep dive, what's the big takeaway from Trader's money management system?
I think the central message is just crystal clear. Money management isn't optional. It's not a side dish. It's absolutely foundational for any hope of consistent trading success.
It's the bedrock.
Totally. It's this blend of understanding your own psychology, applying disciplined risk control, and yes, doing the unsexy work of keeping meticulous records.
And by getting a handle on these principles, even just from this discussion based on the source, you, the listener, have hopefully gained a real head start in navigating the markets.
Definitely a leg up. Which leads us to maybe a final thought for you to chew on.
Go for it.
Think about those three pillars: psychology, risk control, record keeping. Which one of those resonates most strongly with you right now in your own situation?
Yeah, where do you feel weakest? Where do you need the most attention?
Exactly. And following from that, what's just one small concrete step you could take, maybe even today, to start strengthening that specific area in your own approach, whether it's trading or any financial endeavor?
A small step. That makes it doable. And definitely check out those resources he mentioned if you want to dig deeper.
Absolutely. Continuous learning is key.